Imagine you had the single worst investing timing on the planet. Imagine you were so unlucky, so perfectly bad at picking your moment that you only ever put your money into the stock market on the exact days it hit an all-time high, the literal peak. Every single time you invested, you bought at the most expensive price the market had ever been. That sounds like a financial horror story, right? The kind of thing that leaves you broke and bitter. Well, here's the twist that almost nobody sees coming. Decades of hard data say you would have done just as well as everyone else, and in a lot of cases, you would have done better. I know how insane that sounds. It goes against every instinct you have about money. Buy low, sell high is practically tattooed on our brains. So the idea that buying high, buying at the literal top, over and over could actually work out fine, or even great, feels wrong. But by the end of this video, you're going to understand exactly why it's true, what the actual numbers are, the one situation where it genuinely did hurt, and what this means for the cash you might have, sitting in your bank account right now, too scared to invest because the market feels too high. Drop a comment with the price of something you remember being way cheaper years ago, and a like helps this reach more people. Let's get into it. Let me set the stage properly, because this fear is one of the most common and most expensive fears in all of investing. Right now, as you're watching this, there's a very good chance the stock market is near an all-time high. It usually is, and whenever that happens, a specific kind of anxiety creeps in. You look at the charts, you see the line at the top right corner, higher than it's ever been, and a voice in your head says, "Don't buy now, it's too high. It has to come down. Wait for the dip, wait for the crash, then buy." So you hold your cash, you wait, you sit on the sidelines feeling smart and cautious, waiting for the market to hand you a better price. And here's the thing, that instinct feels responsible, it feels like the mature, disciplined move. Everybody's afraid of being the fool who put their life savings in the day before a giant crash. That fear is real and it's human. But I'm about to show you with actual historical data from some of the biggest financial institutions in the world that this instinct has quietly cost patient, cautious people an enormous amount of money. Not because they were reckless, because they were too careful. So let's actually look at what happens if you invest at all-time highs. Not opinion, data. There's a well-known study from JP Morgan that looked at the S&P 500. That's the index of the 500 biggest US companies. The thing most people mean when they say the market, going all the way back to 1988. And they asked a simple question. If you invested on a day when the market was at an all-time high, how did you do compared to investing on just any random day? Now, if the buy low instinct were correct, investing at all-time highs should give you clearly worse returns, right? You bought expensive, you should suffer for it. But that's not what the data shows, not even close. Here's what actually happened. If you invested on any random day between 1988 and 2020 and held for 1 year, your average total return was about 11.7%, and you made money roughly 83% of the time. Solid. That's the baseline. Investing on a totally normal random day. Now watch what happens when you only invested on all-time high days. Over that same period, investing on a day, the market hit a new record, and then holding for 1 year. You actually came out slightly ahead of the random day results. And it gets more dramatic the longer you hold. Investing on an all-time high day, according to JP Morgan's data, gave you a total return of about 50.4% after 3 years, and about 78.9% after 5 years. Compare that to investing on any average day, which gave you 39.1% after 3 years and 71.4% after 5 years. Read those numbers again, because they're the whole point of this video. The all-time high investments beat the average day investments, 50% versus 39% over 3 years. The worst possible timing actually did better than typical timing. The thing your gut screams at you not to do was, historically, the better move. And this isn't just one study from one firm. Fidelity ran their own numbers going back to 1950. They found that the average 1-year total return after the S&P 500 hit a new all-time high was 12.7% versus 12.4% for all other 12-month periods. Again, the all-time high days came out ahead. Slightly, but ahead. Not behind, ahead. Every major analysis lands in the same surprising place. So the obvious question is, why? Why on earth would buying at the most expensive moment produce better than average results? It defies common sense. But once you understand the reasons, it actually starts to make perfect, logical sense. There are a few forces at work here, and I want to walk through each one, because understanding why is what's going to finally kill this fear for you. The first reason is something called the momentum effect. Markets, over meaningful stretches of time, tend to trend. When things are going well, when the economy is growing, when companies are making more money, when confidence is high, that tends to continue for a while. It doesn't reverse the instant it hits a new high. A rising market has a kind of momentum to it, like a boulder rolling downhill, and that momentum often carries prices higher for a long time after a new record. All-time highs aren't the end of a trend. Very often, they're the middle of one. The second reason is the single most important idea in this entire video, and I want you to really sit with it. Here it is. Every single all-time high in history was preceded by a previous all-time high. Think about what that actually means. For the market to reach a record, it had to pass through the previous record. And before that, it passed through the one before that. The entire history of the stock market is a story of records being broken, then broken again, then broken again. All-time highs are not some rare, dangerous event that signals the top. They are a normal, regular, healthy feature of a market that grows over time. Since 1988, the S&P 500 has hit a new all-time high, on average, somewhere around 17 to 20 times every single year. Every year. That's not a warning sign. That's just what a healthy, growing market does. It makes new highs constantly. Let me give you a concrete example that really drives this home. In 1995, the S&P 500 recorded 77 all-time highs in a single year. 77. That's nearly 1 out of every 3 trading days that entire year closing at a record. Now imagine you were the cautious investor in 1995 who said, "The market's at an all-time high, I'll wait for it to come back down before I invest." You would have waited and watched it hit record after record after record, 77 times while your cash sat there doing nothing. And 1995 wasn't even a fluke. The years that followed were some of the strongest in market history. That patient, careful investor missed all of it. This connects to the third reason, which is the one that really costs people: opportunity cost. Here's a stat that reframes everything. The market spends roughly half of all its time within 5% of an all-time high. Half. So if your strategy is, "I'll only invest when we're well below the highs," you are, by definition, choosing to sit out during a huge chunk of the market's history, and specifically during the times when it's healthy and climbing. You're not avoiding risk, you're avoiding growth. Every month you sit in cash waiting for a crash that may not come for years. Your money isn't just failing to grow, it's actively losing value to inflation, quietly getting weaker in the background. Let me make that opportunity cost concrete, because opportunity cost is one of those phrases that sounds academic until you see it in real dollars. Say you had $10,000 ready to invest, and you decided to wait for a 10% drop before putting it in. Now imagine that drop doesn't come for 3 years, which, as we've seen, is completely normal. Over those 3 years, the market climbs, let's say, 30%, while your $10,000 sits in a savings account. When the dip you were waiting for finally arrives and knocks the market down 10%, guess what? The market is still far higher than where it was when you started waiting. You waited 3 years for a discount, and the discounted price is still more expensive than the price you refused to pay at the start. That's not a hypothetical trick. That's the actual mathematical trap of waiting for a pullback in a market that trends upward over time. The dip you're waiting for, when it comes, is very often above the level you're standing at today. There's a fourth reason too, and it's more subtle but just as important: earnings growth. The stock market isn't just a random number that goes up and down on vibes. Over the long run, it reflects the actual profits of actual companies. And those companies, in aggregate, tend to earn more money over time. They grow, they expand, they get more efficient, the whole economy gets bigger. When a company earns more, it's genuinely worth more, and its stock price reflects that. So an all-time high often isn't the price getting too expensive. It's the price honestly reflecting that these businesses are now making more money than they ever have before. A new high in earnings tends to justify a new high in price. That's not a bubble. That's the system working exactly as it should. Now, I promised you I'd tell you about the times this genuinely did hurt, because I'm not here to pretend investing at all-time highs is some magic guarantee. It isn't. And if I skipped this part, I'd be lying to you. So let's be honest about the risk. There have absolutely been moments in history where someone invested right at a peak and then got crushed. The most famous examples are the dot-com bubble peak in the year 2000 and the peak right before the 2008 financial crisis in 2007. If you had put a big lump sum into the market at those exact tops, you would have watched it fall hard, and it would have taken years, in some cases many years, just to get back to where you started. That's a real painful thing that really happened to real people. Anyone who tells you it can't happen is selling you something. But here's the crucial context, and this is where the honest data still lands on the optimistic side. Those catastrophic timing moments are rare. Let me give you the actual numbers because they're reassuring. According to research from RBC and Bloomberg going back to 1950, if you invested at an all-time high, the odds of the market being down more than 10% 1 year later were only about 9%. 9%. So even at record highs, a major correction within a year happened less than 1 time in 10. And it gets better the longer your time horizon. Extend that out to 3 years, and the odds of being down more than 10% drop to just 2%. And extend it to 5 years, and here's the stat that should genuinely change how you think about this. Since 1950, the S&P 500 has never, not once, been down more than 10% at the end of a 5-year period following an all-time high. Never. In 75 years of history, including the dot-com crash and 2008, if you invested at any all-time high and simply held for 5 years, you were never sitting on a big loss at the end of it. So yes, the short-term risk is real, and 2000 and 2007 prove it. But the longer you hold, the more that risk melts away, to the point where over 5 years, it has historically vanished entirely. That's not nothing. That's one of the most reassuring facts in all of investing. Let me put some real recent numbers on this too, because this isn't ancient history. It's happening right now. Coming out of the 2022 downturn, the S&P 500 hit a new all-time high in early 2024, and then went on to close at a record high more than 90 times through the end of 2025. If you had gotten scared out of the market in early 2024 because prices were too high and a new record felt dangerous, you would have missed one of the strongest runs in recent memory. The market returned around 26% in 2023, around 25% in 2024, and around 18% in 2025. 3 enormous years in a row. The cautious person waiting for the big crash missed all 3. And I want to be personal with you for a second here, because I've been that cautious person. I have sat on cash, convinced the market was too high, convinced the crash was right around the corner, feeling smart for waiting, and I watched the market climb without me, again and again, while I waited for a discount that never showed up. That waiting cost me more than any crash ever did. The crash I was so afraid of never came, and by trying to avoid a loss, I created a different kind of loss, the loss of all the growth I sat out of. That's the trap, and I don't want you falling into it the way I did. So what's the actual lesson here? Because I need to be really careful and really honest about what I'm not saying. I'm not telling you to run out and dump every dollar you have into the market right now because it's at a high. That's not the lesson. Timing the market, trying to perfectly pick the top or the bottom, is a loser's game in both directions. Trying to buy only at the tops is dumb, and trying to wait for the perfect bottom is just as dumb, because you'll usually miss the recovery. The lesson isn't about timing at all. The real lesson is this: an all-time high by itself is not a reason to stay out of the market. It never was. The fear that stops so many people from investing, it's too high, I'll wait, is a fear built on an instinct that the data simply does not support. All-time highs are normal, they cluster, they usually lead to more highs, and over any reasonable long-term horizon, investing at one has historically been just fine. And this is exactly where a simple strategy solves the whole emotional problem for you: dollar cost averaging. Instead of trying to figure out whether today is a good day or a bad day to invest, instead of agonizing over whether the market's too high, you just invest a fixed amount on a regular schedule. Every 2 weeks, every month, whatever fits your life. When the market's up, your fixed amount buys a little less. When it's down, it buys a little more. You automatically catch the highs, the lows, and everything in between, and you completely remove the impossible burden of trying to guess the perfect moment. You never have to ask, is now a good time again? Because your answer is always, yes, a little bit, on schedule. Picture it in practice. You set up $200 to invest automatically on the first of every month. That's it. You never look at a chart to decide. Some months you'll happen to buy near a high, some months near a low, and over the years those average out into a price you never had to stress about. The market drops 20%. Great. Your next automatic $200 just bought more shares on sale, and you didn't have to work up the courage to do it because it happened on its own. The market rips to new highs. Fine. You're already invested in writing it up. Either way, you win, because you took the single hardest thing about investing, the emotional decision of when, and you deleted it entirely. That approach does something powerful. It takes this entire fear we've been talking about, the fear of buying at the top, and it just dissolves it, because you're not making one big scary bet at one scary moment. You're spreading it out consistently over years, and history is overwhelmingly clear that staying invested consistently over long periods is how ordinary people actually build wealth in the market, not by timing, by time. Quick honest note, this is educational about how markets have behaved historically, not personalized financial advice, and the past never guarantees the future. Your situation, your timeline, and your risk tolerance are yours. So let me bring this all the way back around and tie it together. We started with what sounds like a nightmare. An investor with the worst possible timing, buying only at all-time highs at the peak every single time. And what we found across data from JP Morgan, Fidelity, RBC, and decades of market history is that this worst possible timing wasn't a disaster at all. It matched and often beat the results of investing on an average day. Not because all-time highs are magic, but because they're normal. They cluster, they carry momentum, and the market spends so much of its life near them that avoiding them means avoiding the market itself. We were honest about the risk. Yes, 2000 and 2007 happened. Yes, buying at a peak right before a crash is painful in the short term. But we also saw that a major correction within a year of an all-time high happened less than 10% of the time, and that over any 5-year period since 1950, investing at an all-time high never left you with a big loss. The short-term fear is real. The long-term data is deeply reassuring. And let me push on the 2000 and 2007 examples a little more because I don't want to wave them away. I want to show you what actually happened next, since that's the part people forget. Take the worst case. Someone who invested a lump sum at the absolute peak in October 2007, right before the financial crisis. Brutal timing. They watched their money get cut roughly in half over the next year and a half. Genuinely awful. But here's what happened if they simply didn't sell and didn't panic. By around 2013, they were back to even. And from there, the market went on one of the longest bull runs in history. Fast forward to today, and that person who invested at the worst possible moment in 2007, if they held on, is sitting on a massive gain, several times their original investment. The peak that felt like a catastrophe became a footnote. The only people who were truly, permanently hurt by 2007 were the ones who sold at the bottom in 2009 and locked in the loss. The market didn't ruin them. Panic did. And the takeaway isn't time the tops. It's the opposite. Stop letting the height of the market scare you out of investing at all. Stop waiting for a perfect discount that history says usually never arrives. The single biggest risk for most people isn't buying at a high, it's spending years on the sidelines, in cash, waiting, while the market and inflation both quietly leave them behind. The old saying is, buy low, sell high. But the honest, data-backed truth is closer to something less catchy and far more powerful. It's not about timing the market. It's about time in the market. If this changed the way you see those scary all-time high headlines, send it to someone who keeps saying they're waiting for the crash before they invest. It might be exactly what they need to see. I'll see you in the next one.